Colleagues, it's 2 p.m. Sabata. I'm doing a review of NVDA, NVIDIA. This one was really prompted by two things. I got to see this posting when I'd already done my analysis, my initial analysis on this one. What I'd observed, what I was looking for when I ended up doing this analysis was I had screened for charts for stocks with high beta, more than 2. And I wanted those with a market cap of more than 20 billion, and I wanted ROI and ROE more than 20. That was what roughly I was looking for, but a very volatile stock which could go up and down with a chart which looks more like a commodity. Once it goes up, it keeps going up. When it's going down, it keeps going down. That's the chart pattern which I wanted to see, which acts more like a commodity. And NVIDIA Corporation fitted the bill. Then when I started analyzing this summarized part of the fundamentals, I thought it was interesting. This is a stock more than 100 billion. The PE, I did not like it as a long-term investor, but as someone who had the intention of shorting this stock, this is works well for me. It's currently sitting at a PE of 54, and the forward PE is only 30, a significant drop. And yeah, most of the stuff doesn't look good, but its debt to equity is very good. There's little debt. Its earnings this year is expected to be 30 to 31% there in that region. That's where it's always kept it anyway. And sales growth for the past 5 years is great. Last quarter is terrible, but we understand the way this US-China war impacted mainly these semiconductors. And yeah, everything else looks fine. This is expected in the good region. Definitely, I know it's making some money. But once you start seeing a stock with a beta of in the region of 2 and more, you know that their cost of equity, their cost of capital is very high. Given the average in the US, the last time I did a proper check was around 7 to 8% cost of capital. And looking at NVIDIA, knowing that its beta is about 2, so we'd expect that to be around double in the region of 14 to 16, somewhere there. That's a thumbs up number, but I really did a proper analysis. We'll get to it and find out. So this scenario was looking good. The beta is what I was looking for. And I did an analysis on NVIDIA, and that's where I'm going to take you now. But before I take you there, just a quick one. Whenever I do this fundamental analysis, I also check these analysts, what they are saying. I like this one. The street quant, it doesn't have much for me to work on, but here's one part which I like a lot. I like stock performance. Compounding, if it's more than 20% compounding annually, I like that. And this one is about 40, so that's good for me. Growth, it's in the region of 23% compounded for the past 3 years. That's good. So when it's growing, it's growing. I don't like the PE in comparison. It's almost double that. But the beta is also double the market. So it's within the range. NVIDIA is not a great stock. It's on the red. For me, who wants to short it, it's in the right place. Given all these and asked to choose which one I would short, this would be my take, NVIDIA or Micron. So yes, you might look at it and say it's poorly performing in comparison with the others, but my intention is to short it, so it's in the right place. There it is again in the red, unfavorable. That's where I would like to short it. I don't want to short the star performance like Qualcomm there or Intech. So yeah, that's my take on this one. I won't dwell much on the other reports which I had. Oh, I did not even include them here, but that's fine. Then the next analysis I will take you to is the actual intrinsic valuation calculation. On the cost of capital, which I was talking about, the cost of equity is about 15.82%. The key drivers of this is the beta, which is 2.06. I used the regression one. I did not build it up from bottom up. I did not have enough information to build it up there, and I did not do my proper homework there. But I went with the regression one, 2.06. That's what I had there. And the other driving factor is the risk premium. On the risk premium, it's calculated based on where its revenue is coming from. That's what it does there, and it is an average of 6.7%. You combine these and these using a formula, which is standard. I'm not going to go into it. You come up with the weighted average capital. Compared is 15.8 and 2% there, which gives us a 15.5. That's our cost of capital. That's the risk-free 10-year treasury bond, which I use as risk-free rate. Everything else is populated from the financials. My growth rate, I'm working with 20%. And my targeted operating margin is 30. I know I'm a little bit on the upside when compared to this, but on the downside when I'm comparing it with the previous year's one, but I'm happy with 30. Reinvestment, I'm stuck with 1, which is almost equal to what it was for the previous year. They have some employee options. Yeah, and I populated some of my assumptions, which are not much. The terminal values there, nothing much other than that. And when I put it all together, I come up with an estimated value per share of 124. And it's currently trading at 150, which is grossly overbought. And coming to the actual chart to show you in comparison where it is, using a daily chart, we are somewhere here in the 209 region. This dotted line tells me, based on daily chart, this is the top. We're in that topping zone. That's why I did my analysis there, and I expect it to drop like a stone in water. That's where we are currently. The white line is where I did my evaluation and how I called it. And the value is down here at levels which we last saw in December last year. To bring this into perspective, if I pull it in a weekly chart and use the 5-year period to have an idea of where we are compared to that period, that's the bottom we hit last year there. That's about where it's currently. It's pulled a bit and it's bouncing in the lower end of the thick cloud there. Expected to come down crashing. Technically, I'm not going to deal much with this, but in my tweet, I had mentioned that, let me just deal with it a bit. I had mentioned that I'm seeing divergence. On the daily chart, price is making new highs using this tip where they were all grouped there, and using this tip where they were recently all grouped, price is making new highs. They were grouped there, using this tip and that one, price is making new highs. RSI is refusing to confirm. It's flat to lower. So this is cleared normal sales divergence. But when we go and look into the weekly chart, there we are. This is making a new top. RSI is making a new top. Price is not confirming it. Price was last at the top here, using this point. That's where price was. And now it's nowhere close to making a new top, yet RSI is making a new top. This is called reverse sell divergence. That's what I was talking about in my tweet when I mentioned here that on daily chart, normal sell divergence. On weekly chart, there is reverse sell divergence. Pronounced grouping of stocks, RSI, that's what we are seeing there. This is what I was referring to. But one more thing I want to talk about is I mentioned that their debt is very low. When I looked at it here, I said they have insignificant debt, which when I did my own calculations of what would be the optimum debt will be about 10%. Currently, they are sitting at 1.66%. So there is really low stuff there. It's one way you could really say, if you're a private equity guy, you could borrow some money and balance this and even make more money. If you just borrowed about 8% more, brought that debt to about 10%, increasing it by that, you will be at the optimum and make more money. But seeing that they are hitting new highs, I think they are not carrying too much debt will help them a bit not to crash and burn, which is not very good news for me as I'm tending to short this. Then the other element which I looked at is their return on invested capital. Their return on invested capital is about 17%. Remember I said the cost of capital is down at 15.5. Yes, they are making money. They are making money, and return on equity, I'd say my return on equity is about 15 points. Let me just go and get it. Return on equity is 15.8. Return on capital is 15.5. So if I do my calculations for return on equity, they are both above 15. Return on equity is significantly above. It's a safe bet. The company is making money, and yeah, it's a good, well-run company. But technically, we are not in the right place, and technically, I expect this to come down, crashing a bit. That's why I will be putting an option structure. I already did put an option structure there to come down. But I always structure my trades that if I'm really wrong and this thing goes by 5% higher than where it is currently, I'll break even and make about 1% or so. If it comes down, it's highly leveraged, my option structures. Once it hits about 13%, I'll be talking serious money, more than doubling my return. And just to illustrate, what have I done? Didn't want that. What I want is to show you the percentage on its way down. I expect something in the region of 40% for it to come down to where I think value is. Even if it were to come down to this level here, it will be about 37. If it came back to this level around here, it will be about 12, 13%. Just by coming to retouch these levels where you have this line of mine here, these levels here, it will be about 19% already, more than 13%, which will be great by me. So yeah, but I expect a serious drop on NVIDIA. That's my analysis for this one. That's where I'm expecting it to go. Just wanted to drop a video, but I've not gone into the details of my analysis. I no longer do that. I've done it before in previous videos. But what I usually do is attach the working papers so that if somebody is really interested in finding out how I came up with this value of 124, they can go back into my inputs, look at how the spreadsheet works. This template is from Dr. Aswad Damodaran. That's where I learned my valuations, my intrinsic valuation. Also, these two other ones which I refer to of the optimum is coming from his templates. I use his templates. Same as return on equity and return on capital. I use the same templates. Technical analysis, my information is mainly driven by the teachings of Dr. Clive Ravi. I combine all that, and yeah, the option structuring is my own. 100% my own, but it was more of a research of trying to find a situation where If I'm wrong, I get paid. If I'm right, I get seriously paid. If the stock doesn't move at all, I'll still get paid because I get into the trades with a credit in most cases. If it hovers around that entry zone, I'll just use butterflies to break even and get away with it. I'm covered. My portfolio is insured. That's 2 p.m. Sabata signing off. Bye-bye.